That's fine. Oh, you're gonna restart the recording. Okay.
Yes. Okay, so just as a disclaimer, this presentation and any part of it is purely for education.
Evan. Okay, just try to talk clearly then, and make sure that present us a definition, and we're all.
Okay, can you hear me okay? Can you hear me okay?
Yeah.
Yep.
Okay, thank you. All right. Okay, so just as a disclaimer, this presentation and any part of it is purely for educational purposes and not to be taken as any sort of advice, especially not financial advice, nor is this for commercial use. Also, all art is AI generated by using the Midjourney bot and the "this person does not exist" website with the free AI generated faces. So here's just a couple definitions. High-frequency trading is characterized by the usage of algorithms to place large volumes of trades for financial instruments at high speeds. Arbitrage is the synchronous buying and selling of assets in different markets or derivative forms to capitalize on potential price discrepancies. It's important to note that this is seen as a quote-unquote riskless profit. This becomes more rare as market pricing becomes more efficient. Usually the spread in the asset prices is pretty small, but it remains profitable as someone may execute this trade many times. Trading arbitrage is encouraged to increase efficiency in markets. Now, I'm going to give an example in layman terms for arbitrage. Say you were at some athletic store, two athletic stores side by side, and there's a pair of sneakers. Also, the store has to be able to buy and sell items, so you would be able to go there and buy and sell an identical pair of shoes at both stores, side by side. One of the stores offers a pair of shoes for $150, the store next to it, $125. Someone who is pursuing arbitrage would go into the store selling shoes for $125. The person would then buy those shoes for $125 and just sell them to the store over for $150. So pretty simple. What this typically looked like in markets, like stock markets and financial markets not that long ago, was when trades were much slower for digitization. People would be able to buy something on, say, the New York Stock Exchange for maybe a couple pennies or $1 cheaper and find the identical asset on another market and just buy and sell. An example I gave, but in modern times after digitization, this is pretty rare to see. It's virtually impossible, but we can still pursue arbitrage with derivatives and an index or an exchange traded fund that's comprised of many different assets, and then just using AI or manually doing it, but that again virtually it's not realistic to do that, and then trying to see if there's any price discrepancies from an index and its individual components. Okay. Latency. This is just the measurement of how long it takes for data to reach a server and back. In this case, the time it takes for the computer signal to receive a signal back from the server for this presentation. Front running, or also known as tailgating. This is prohibited by law, so it's an illegal act of engaging in an equity trade, option, futures contract, derivative, or security-based swap in order to profit from having material, non-public knowledge of an influential pending transaction that will affect the price of the underlying asset. So basically, all of these different words here, options, future contracts, forwards, all of these are just different financial contracts, financial instruments, and you're just placing your order in front of a pending influential order, which one would have private knowledge of, right? And this is illegal. I don't know if that's intuitive on why that would be, but it gives a very unfair advantage in markets. Now, the way that this used to happen, say someone worked at a brokerage, right, and they were filling out an order manually, how, again, before digitization and such, and someone saw a very large order come in that they knew was going to be influential. Well, if I just work at the brokerage, why not just put my order ahead of this one, right? And so that would be an example of front running. Again, it's highly illegal. Next slide. So just a couple quick facts. So here we can see there's estimates of 20 to 80% of trading volume on a given day is a result of high frequency trading. Latency arbitrage may cost investors / traders up to 5 billion USD annually across exchanges globally. This is according to the UK's FCA. And firms spend in the hundreds of millions to shave milliseconds off of trading time. So I just gave an example of a news article about Goldman Sachs, a really large, well-known financial institution, but I've definitely seen many other examples of financial institutions doing this. All right, so how does it work? This is the bread and butter of this presentation, really. I was listening to a presentation by Brad Katsuyama. He went to school here in Ontario, but he was an institutional trader for RBC that overlooked risk trading for US equities. He describes a situation that lasted for a couple years, starting in 2006. He stated that initially if he saw an ask order of $2.91 for 100,000 shares, initially he could just enter that into his computer, get all 100,000 of those shares at $2.91 per share. Then he says by 2007, if he saw that same ask order of $2.91 for 100 per share for 100 shares, he could enter that into his computer and only get 80,000 shares. By 2008, he describes only getting 70,000 shares. By 2009, he says he would only get 45,000, or in other terms, 45% of what the ask was. So what the offer was. Brad would then say he would call tech support saying his computer wasn't working. A guy from tech support would come out and ask what's going on. Tech support would then just say that it's because Brad was trading in volatile markets and other people want to buy the shares that Brad is buying. Brad then says, okay, watch this. He then shows the ask order and says, I'm going to try to buy this ask order. And if while I'm counting the stock is trading, you're right, other people just want to buy shares of the company that he's trading, AMD. But nothing's going to happen until I press this button. He describes counting and nothing happens. But then when he presses the button, offers disappear. He states that he himself is the quote-unquote event. I'm the event. This is not a random occurrence. People want to buy AMD because I'm buying AMD. Brad says this event went on for a couple years and he had no idea what was happening or why. He describes chatting with an acquaintance from one of the biggest hedge funds in the world that used algorithms from some of the largest financial institutions in the world. They were also experiencing the same problem that Brad was facing, where they would see something on their screen, go to buy it, and only get a percentage of what they were seeing. Then it sort of clicked to Brad that this issue seemed to be more systematic and that it wasn't just him experiencing it due to subpar technology of the company he was working at. In 2009, Brad began learning about high-frequency trading. People from high-frequency trading, who Brad hired onto his team, explained to Brad that when you see that 100,000 shares on your screen, that's not all just coming from one stock exchange, but rather 13 exchanges at the time in the US that were geographically located at different buildings. Now this is really important because of latency. For example, me giving this presentation right now, the first person to see and hear it would be someone directly beside me, watching and listening to my presentation. Then likely whoever in the group is closest to me, like if Ahmed was in the presentation right now and they were watching from Edmonton, and the last person to see it might be Sirath if he's in Nova Scotia or Singapore, right? The actual time discrepancy in real life or normal life is essentially meaningless to us, right? But on Wall Street, this is critical. So how long does it take for a trade order to reach an exchange? Well, that depends. It depends on your location, trading volumes on that given day, at that given time. Latency fluctuates, right? And of course, the degree of one's technological advancement does matter at their firm. So Brad goes on to say that when you see those 100,000 shares listed, pressing the button once isn't just one single action. Pressing the button sends a message to what's known as a smart order router, which then splits the order into different messages and sends those signals to 13 different stock exchanges at the time in the US. He gives an example of sending an order and it being routed to the 4 biggest exchanges at the time: BATS, Direct Edge, New York Stock Exchange, and NASDAQ. BATS being the closest geographically to Katsuyama, and NASDAQ being the furthest. If the order gets sent out, they'll arrive in sequence. So first to BATS, then Direct Edge, New York Stock Exchange, and then NASDAQ. Again, this is all purely based on how close the exchanges are. So at this time, the difference in time for his order to arrive at the first and last exchange was only 2 milliseconds, or 0.002 seconds. At the time, he thought this was pretty fast, considering it takes, on average, 100 to 400 milliseconds to blink a person's eye. So one of the people hired on Katsuyama's team came from building high-frequency trading infrastructure at some of the largest or some of the biggest firms in America. He told Brad that their discrepancy was only 476 microseconds. So a microsecond being one millionth of a second. Microsecond, 1 millionth of a second. Brad was still operating in milliseconds. So basically what he found had been happening to Brad all of these years, these high-frequency traders were detecting the signal arriving at the first exchange and then racing the order to all of the other exchanges, getting there before Brad. If it was a buy order, the high-frequency trader would cancel all sell/short orders, then place buy orders ahead of the delayed order coming from Brad on their way to the further exchanges, right? So the high-frequency trader would catch the order at BATS and then race them to the rest of the exchanges. So sort of an interesting thing to mention, the way Katsuyama combated this issue, he knew they couldn't arrive faster than the high-frequency traders, given that he was at the Royal Bank of Canada. So what they did is they worked on decreasing their arrival variance to 290 microseconds by just delaying the signal that would get there first and focusing on getting the last signal there as fast as they could, focused on getting the signal to the closest exchange as slow as they could. Slow enough, like as close, just to minimize the spread, right? Get the signals there as close to each other as they could. And so due to latency fluctuations, they said this being very difficult for the team, according to Katsuyama, but when they were able to get that variance to 290 microseconds, just by slowing down their faster signals, by slowing that down, this ended up being a $100 million product that they sold to clients, right? So I just want to give a real market example for this latency arbitrage. So suppose you go to some store or market, you purchase some goods, maybe a bundle of goods like some food, some shoes, or even just a coffee at a restaurant. You arrive to checkout to pay for the goods. After making the purchase, the vendor then takes a portion of the goods that you just bought. Maybe they take a portion of the goods back, only give you one shoe, or maybe just pour some of your coffee into another mug. Then the vendor tells you, oh, someone else already paid for those goods while you were paying, right? You probably be like, what the heck? Okay. And so then my question to present to the group, before saying anything, this presentation is certainly not to disparage high-frequency trading or arbitrage. Arbitrage does make market pricing more quote-unquote efficient. A high-frequency trader arbitraging an index to its individual assets that compose the index, or using arbitrage with derivatives and their underlying to ensure futures, forwards, options, etc. are priced correctly is not inherently evil. And also it can be argued as doing a good thing, because when you arbitrage it, it puts a price pressure for that thing to go towards its quote-unquote correct pricing, right? But I must ask this question to those listening. Is this practice of latency arbitrage really an efficient use of resources and talent? Right? We have these really smart, talented young people going into this field just for that short-term profitability, right? Is this in society's best interest? Can this be thought of as an inefficiency in our current system? Us spending so many resources to race each other's orders within microseconds to get a discount on financial instruments, or to essentially front run someone else. It's technically not considered front running, but I consider it to be pretty similar. I mean, you're just kind of going ahead of someone else's order to the rest of the exchange. Let me know. What do you guys think? And also Q&A. Thanks for listening. But yeah, any thoughts to that question?
Yeah,